It's January 29, 2026, and the screens don't look real. Trading desks glow like emergency rooms. Red numbers flash, then vanish, then come back bigger. The USS Dollar Index, DXY, flickers around 96, and the room goes quiet in that specific way people get quiet right before something breaks. If you've never heard of DXY, you don't need a finance degree to feel what it means. It's basically the dollar's report card against a basket of other major currencies. When it's high, the dollar is the loudest voice in the room. When it's low, the world starts testing what happens when that voice cracks. And 96? Traders treat it like a floor. Not because it's magical, but because so many bets, hedges, and this can't possibly go lower. Assumptions sit right on top of that number. The dollar fell to about 96 on January 27, its lowest level in roughly 4 years, then tried to fight its way back. Today, it's clinging to 96 like a climber gripping a ledge with fingertips. Now cut to the other screen. Gold, not inching up, not rallying, in the polite way headlines like to say. Gold is sprinting, and it doesn't care that the dollar is attempting a bounce. Gold traded in the 5,500 zone this week and printed an intraday high near 5,590 on January 28. That's not a normal move in a normal world, that's price discovery with the volume turned all the way up. There's an old rule people learn early: when the dollar goes up, gold goes down. It's the basic seesaw of global markets. Stronger dollar means it takes fewer dollars to buy the same ounce, so gold should cool off. That relationship has held for decades often enough that it became muscle memory. But here we are, gold rising while the dollar tries to stand up. That's the decoupling. That's the moment the market stops treating gold like a commodity and starts treating it like a referendum on trust. You can feel the narrative changing in real time, not in speeches, in behavior. In the way orders hit the tape, in the way people stop asking, "Is this overpriced?" and start asking, "What if I can't get it later?" The U.S. Treasury knows this is not just numbers, it's optics. Over the last day, Treasury Secretary Scott Bessent has been out there repeating the classic line: the strong dollar policy is still intact. The U.S. isn't chasing a weaker currency, and talk of intervention is off the table. The message is simple: we're not going to push the dollar down on purpose, and we're not going to rig the market to get a cheaper exchange rate. And yes, markets reacted. The dollar rebounded against major currencies after those comments. For a minute, it looked like the system still responded to reassurance, like confidence could still be spoken into existence. But in 2026, words don't outweigh math. The biggest number in this story is not 96, it's the national debt. As of early January, total U.S. gross debt was around $4 trillion. That number is so large it turns abstract, so translated into something human, it's a machine that eats interest. Every additional trillion is not just a headline, it's years of future payments. And payments compete with everything else a country wants to do: defense, healthcare, infrastructure, emergencies, the next crisis nobody can predict. So, when officials say strong dollar, investors hear an unspoken question: how? Because keeping a currency strong is easier when budgets look controlled and politics looks disciplined. It's harder when deficits feel permanent and the cost of borrowing is still real. This is where the panic gets misunderstood. People think gold buyers are just afraid of one bad day. But a lot of this move is about the long game. It's about what happens when the world quietly concludes that the debt trajectory is the policy. And this is where the politics add fuel, because the messaging is split screen. On one side, you've got Treasury trying to project stability. On the other, you've got tariff threats and trade pressure cycling through the news like a storm system. Canada, Mexico, Europe. Then Greenland. Yes, Greenland, showing up in global markets as a real diplomatic flashpoint after Davos. Here's why tariffs matter even if you don't follow trade. Tariffs can push up prices by making imported goods more expensive. They can also scramble supply chains, forcing companies to change suppliers, rewrite contracts, and stockpile inventory just in case. That uncertainty is inflation's best friend. Businesses don't wait to be hurt, they raise prices early to protect margins. Then consumers feel it. Then voters get angry. Then politicians do more short-term things. That's the loop. When markets sense a volatility loop, money runs toward assets that don't need a stable political mood to exist. Gold doesn't care what a speech says tomorrow. Now zoom out, because the gold story isn't just traders surfing a wave. The real weight is coming from institutions that don't chase trends. Central banks. If you want the simplest explanation for the gold fever, a lot of governments are buying gold the way people buy insurance. Quietly, steadily, and with the assumption that they'll be grateful later. China is the headline here. Publicly reported Chinese gold reserves were a little above 2,300 tons by late 2025, and major reporting has suggested China has been one of the largest official buyers. The exact true number is debated because not every purchase shows up immediately in official data. But the direction is undeniable. More gold, less reliance on someone else's promise. India is another signal. The Reserve Bank of India's gold holdings have moved past 880 tons in the 2025-26 fiscal year, with the market value of that gold rising sharply as prices climbed. India isn't doing this for drama. It's doing it because gold is a reserve asset that can't be frozen, sanctioned, or switched off. That's the key shift people miss. Gold is nobody's liability. A government bond is an IOU. A currency reserve in another country's system is permission-based. Gold is possession. And then comes the retail wave, the part that makes the story bigger than boardrooms. A few years ago, people buying gold at Costco sounded like a novelty, a late-night joke. But once the idea is planted, once people realize they can buy a bar like they buy a television, the behavior sticks. In 2026, it's not cute anymore. It's a signal. Everyday buyers are moving into bullion, small bars, fractionals, and the digital versions of gold through ETFs. The product doesn't matter as much as the intention. Get something that feels solid. Even the digital gold trade is changing. The World Gold Council reported that 2025 was a record year for global gold ETF inflows and that total assets under management more than doubled, with holdings rising significantly. That's not just fear. That's allocation. That's portfolios rewriting what they consider normal. Now, at this point, dollar bulls will push back, and they deserve to be heard because it makes the story stronger. They'll tell you the dollar still runs the pipes of global trade. They'll tell you US markets are still the deepest, most liquid place to park serious money. They'll tell you that in any real crisis, people still rush into dollars, not out of them. And they'll point out something true: no other currency has fully replaced the dollar's role. All of that can be true and still miss what's happening right now. Because the red flag isn't simply that gold is up. The red flag is that gold is up while the dollar tries to rebound. That's not just panic. That's a hedge against the system itself. It's people saying, I'll keep the dollar for transactions, but I want my savings outside the argument. And that brings us to the heart of this documentary, the death of the safe bond. For generations, the US 10-year Treasury was treated like the safest asset on earth. It was the anchor. If you wanted stability, you bought the bond and slept at night. The world built models around it, pensions held it, central banks stocked it. But anchors can turn into weights when the ocean gets rough. As of this week, the 10-year yield is sitting around the mid-4% range, about 4.25%. That sounds fine until you compare it to gold's recent move. If you hold a bond yielding 4% and gold rises 20% in a month, that 4% starts to feel like you're being paid to stand still while everything reprices around you. And here's the trap. If investors demand higher yields because they're worried about inflation or debt, bond prices fall. Falling bond prices hit portfolios and financial institutions. Higher yields raise borrowing costs across the economy. Mortgages, car loans, business loans, government financing. The safe asset becomes a source of tightening. This is why the bond story matters, even to people who have never owned a bond. Your loan rates are downstream from this. Your rent is downstream from this. The price of everything that needs financing is downstream from this. So when gold takes the spotlight, it's not only a shiny metal story. It's a story about what people believe will hold value when the plumbing gets noisy. Now we go geopolitical, but we do it the right way. No side quests, no random headlines, only what moves the money. At Davos, Greenland became a market event. Not because traders suddenly care about ice, but because the Arctic is logistics, shipping lanes, security, and resources. Talk of tariffs and territorial pressure spooked allies and forced technical talks with Denmark and Greenland officials to calm things down. The message to markets was simple: even friendly relationships can get transactional fast. And in Venezuela, USS, officials have been defending the administration's recent operation that helped push Nicolás Maduro out, while trying to convince the world it doesn't mean open-ended intervention. Again, the point is not your opinion of the policy. The point is, what markets here? Energy flows, sanctions, retaliation risk, regional instability, and the possibility of surprise. Surprise is expensive. Surprise gets priced into everything. And when surprise becomes frequent, investors stop paying for promises and start paying for certainty. That's the resource. Nationalism thread tying it all together. Countries are treating supply chains like weapons and minerals like strategic inventory. Silver matters because it's used across electronics and energy systems. Gold matters because it sits in vaults as a neutral reserve. When nations rearm their balance sheets, they buy hard assets. And this is why the forecasts are getting louder. Goldman Sachs raised its 2026 gold target to 5,400. Bank of America's strategists have talked openly about scenarios that reach 6,000. The important point isn't whether the next stop is 5,800 or 6,200. The important point is that 6,000 no longer sounds like a conspiracy. It sounds like a plausible chapter title. Still, a serious documentary can't just chant higher numbers. So here's the sober question: what would actually stop this? If inflation cooled fast, if fiscal discipline suddenly became fashionable, if geopolitics calmed down, and if yields offered investors real purchasing power protection, gold could pause. It could correct. It could even fall sharply in a risk-on wave. But the world isn't pricing that calm. The world is pricing a longer era of friction, trade friction, political friction, and debt friction. And that's why the gold bid feels structural, not just emotional. Now bring it back to the final floor, because that's the image people will remember. The dollar is fighting for 96 like it's defending a border. It may hold for a while. It may even bounce. It may trick the crowd into believing the worst is over. But gold is acting like the crowd already left. This is the new world ledger. Paper still works, but it's leaking. And when people see leaks, they don't wait for the ceiling to collapse. They reach for something they can hold. So ask the question that flips the whole story on its head. We used to ask how much gold costs in dollars. In 2026, we've started asking how many dollars a gold bar can still buy. That's not a slogan. That's a shift in how the world measures trust. And once that shift starts, a number on a ticker, 96, 100, 90, becomes less important than the direction of belief. The great flip isn't coming. It's happening. If you want more breakdowns like this, fast, clear, and real, subscribe now to Simple Financial Insight, because the next move won't come with a warning.